Hey, good morning, guys. It's Cousin Marv, and this is the analysis of the chart on Tuesday, June 18th, just a day before the FOMC announcement on interest rates. And the market was expecting, or I should say computers were expecting, interest rates to go down. And, well, I'll show you that in a minute. I'll show you why in a minute. Now, remember, when you're trading, who are you trading against? You're trading against other traders, of course, but you're also trading against the computers from Goldman Sachs, from UBS, from Chase, from you name it. Every financial institution has had computers, high-speed computers, trading their accounts. And remember, trading is a zero-sum game. One side of the trade wins, one side of the trade loses, and that's it. So you want to go where the market is going. And sometimes it's easy to tell where the market is going. Sometimes it's not. On June 18th, it was easy. The market opened here at 29.14 at 9:30. Here we are at 9:30, and there was a whiff of interest rate decline in the air. The FOMC, under pressure from President Trump, is being pressured to lower interest rates, and yet a few days ago, UBS and Goldman Sachs came out with the announcement, a bold announcement, that interest rates were not going to be lowered this year. Now, look, nobody knows which way the market is going to go. Certainly, interest rate declines are going to boost stock prices, and interest rate increases are going to lower stock prices. So there was a great deal of talk that, especially on CNBC, and I have my channel tuned to CNBC, there was a great deal of talk about interest rates being brought down a quarter of a point or an eighth of a point. And yet, as I said, Goldman Sachs and UBS both came out with an announcement the previous day, June 17th, that interest rates were not going to be lowered. At any rate, at 9:30, there was a little bit of vacillation. This is a 3-minute chart, and every horizontal bar represents 2 points, okay? So when the market opened, we look for a pop, and we want to jump on the pop. And is there one? Well, the market opened at 29.14, went up a bit, went down to 29.10. So you might think that you'd want to hop on at 29, down here. But too early in the day to really say where to jump on. Remember, we don't want to lose money. We want to be sure. We want to know that we are trading in the direction of the trend. So 9:33, the chart the candle is uncommittal. 9:36, we have a doji. That doji shows some indecision. Okay, so we don't do anything. We're just standing by the side. It's only 6 minutes into the trading day. And then at 9:39, the market goes up, continues going up, breaks the high of 29.1550, continues going up, and this would be a key to hopping on. Even though the stochastics are at almost an overbought level, these are special circumstances. The atmosphere around FOMC announcements are special circumstances. So you have to go with your gut. Use the force, Luke. When you see the prices, and of course, you know what's happening in the market. We have just two things. We have the tariff wars, the trade wars, and we have the interest rates. But the interest rates are right in our face, with President Trump extolling Board Chairman Powell, the chairman of the Federal Reserve, to lower interest rates. We see what happens here. Now, what's happening here? Well, As prices go up, you should have jumped on right here. You should have jumped right on because you see a big spike here compared to the previous 9 minutes. So here we are at 9:39, and we see prices starting to rise. Even though stochastics are up at a high, you got to take a leap of faith, guys. Jump on. And if you did, you could have gotten on. Let's say 29.17 would be a pretty good play, especially with momentum moves. Remember, we're trading momentum, stochastics, and price action. So price action and momentum are telling you market's going up. Now, 29.15, you jump on, and let's say you ride it up. You wouldn't have gotten out here. There's nothing to get you out. You just continue riding it up to the next 3-minute candle. And then the candle starts pulling back 2 points. You might have jumped off here at 29.28 and picked up 13 points. Not too bad there. If you stayed on, okay, it would have backed off. The candle would have backed off to 29.26. You might have chickened out and gotten off there. But yet, prices really didn't decline much. And with the big momentum move previous to that, could have stayed on and ridden it out to right to here to 29.32. So could have picked up 17 points. Hello? Tough call. But even if you picked up 13 points, you would have done great. Okay, so the next candle, 29 at 9:51, we see the high only matched the high of the previous candle. So that would have been an indication that maybe this rally has run out of steam. Remember, what goes up must come down. There's always a top, there's always a bottom. And of course, stochastics, well, we weren't listening to stochastics before, but still in all, price action was what the guiding force was over here. What happened with this candle? You know what this candle was? This was the computers from every bank and financial institution trading against themselves, and you just went along for the ride if you got on at 29.15, which you should have. So at this point, if you made between 7 and 17 points, what did I say? 17 points? Yeah. You would have done great. And if you did, go home, relax for the day, shut off your computer, and enjoy the fact that you had a nice day. If not, market would have backed off, and maybe if you didn't chicken out, you could have held on for this consolidation, which really didn't take out too much of your profit, and ridden it up here to 11 a.m. to this, almost shooting star, to this not quite reverse hammer, but still it was a signal that the bulls were being overpowered right over here, and you could have gotten out. Moving over to the rest of the day. The rest of the day really is just an up and down chop. The play was in the morning, right over here, or over here if you stayed in till 11. At 3 o'clock, if you traded toward the afternoon session, what were our signals? Well, starting at 3 o'clock, right around here, we really didn't have any signals. We were in an area of up and down consolidation, just very, very small moves for these 3-minute candles. Then at 3:30, we had a 1.5 down. Maybe we would have hopped on there, but there's really no strong signal here. This candle going down, there was no. The only reason that you might have taken a trade here was it corresponded with the stochastic being overbought or just about overbought, but really it's not a strong signal. Here that we have a dragonfly doji corresponding with a not too strong signal in the stochastics. It would have been a signal to get on, and if you did, could have picked up 3 points. Okay, so that would have been your day, and that's my call for June 18th. It was a great day to trade, and if you were a student of mine at Trading Mastery for Financial Freedom, you would recognize these signals: price action, momentum, price and support and resistance. So that's my call for June 18th. I hope you rode that market up the day. And remember, Trading is something that you want to have mastery of. Now, if you don't know who I am, my name is Marv Eisen, and my website is Timeless Dollar. I try to give people a way to avoid running out of money, either if they've lost their jobs or if they're seniors, they're afraid of running out of money. And if you fall into that category, please go to my site, timelessdollar.com, check out my course. It's not expensive. Anyone could learn to trade if you have the right mindset, if you have the right training, and you gain the experience that I'll take you there to gain that experience. You don't have to live in poverty in your senior years like so many others are. Anyway, Marv Eisen, Timeless Dollar. Check out my course, Trading Mastery for Financial Freedom, and I'll see you in the next video. Have a great day.